Imagine an entire region of economic miracles hailed as the future of global growth suddenly brought to its knees. What happens when the party stops and the bills come due? This is the story of a financial collapse that changed the world forever. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. The 1997 Asian financial crisis is far more than a historical footnote. It's a foundational case study in modern global finance. This event didn't just shake a region, it fundamentally reshaped how economists, central bankers, and institutions like the IMF understand capital flows, financial vulnerability, and the hidden dangers of rapid, unchecked growth. The crisis brutally exposed structural weaknesses that are common to many emerging markets, even today. We're talking about a dangerous reliance on short-term foreign borrowing, mismatches between currency values, and speculative asset bubbles that seemed too good to be true because they were. The lessons learned from this turmoil are now embedded in the safeguards designed by the World Bank, central banks, and global financial bodies to prevent contagion. In our hyper-interconnected world, where a crisis can spread globally in a matter of hours, understanding what happened in Asia in 1997 isn't just important, it's essential. Before the crash, East and Southeast Asia were the darlings of the global economy, celebrated as the Asian tigers. For decades, countries like Thailand, South Korea, and Indonesia experienced astonishing annual growth rates, often exceeding 7 to 10%. This boom, however, was built on a precarious foundation, a massive influx of foreign capital, particularly short-term loans from Western and Japanese banks eager to cash in on the region's success. This flood of easy money fueled enormous asset bubbles. Real estate prices in cities like Bangkok and Seoul skyrocketed, and stock markets soared to dizzying heights. Corporations, confident that the miracle growth would last forever, borrowed heavily in foreign currencies, especially US dollars. Compounding the risk, many of these economies maintained currency pegs to the US dollar. While this provided stability during the boom years, it became a fatal flaw as the dollar began to strengthen. This made their exports more expensive and less competitive, placing immense pressure on their foreign currency reserves as they struggled to maintain the artificial peg. Thailand was the first domino to fall. The country was running a large current account deficit, a clear warning sign that it was spending far more on foreign goods and investments than it was earning from its exports. Its currency, the Thai baht, was pegged to the US dollar at a rate that was clearly overvalued. This created a golden opportunity for speculative attacks from hedge funds and global investors who bet billions that Thailand could not defend the peg. The Thai government tried desperately to hold the line, spending billions of its foreign reserves to buy up baht on the open market. But it was a losing battle. Its reserves dwindled rapidly. On July 2, 1997, the government was forced to surrender. It abandoned the peg and allowed the baht to float freely. The result was an immediate and catastrophic collapse in the currency's value. This single event sent shockwaves of panic across Asia as terrified investors began pulling their capital out of neighboring economies that they perceived to have similar vulnerabilities, triggering a devastating chain reaction. The contagion spread with terrifying speed. Indonesia was hit the hardest. The value of its currency, the rupiah, plummeted by more than 80% against the dollar. This currency collapse wiped out corporate balance sheets overnight as companies that had borrowed in dollars suddenly found their debts impossible to repay. A wave of bankruptcies swept the nation, plunging the economy into a deep depression. The economic collapse ignited widespread social unrest and violent protests, ultimately leading to the fall of President Suharto after more than 3 decades of authoritarian rule. The political instability only deepened the economic crisis, creating a vicious cycle of chaos and decline. South Korea, one of the world's largest economies, was next. Its weakness lay in its massive, short-term foreign debt, which had been channeled through a fragile banking system dominated by giant family-owned conglomerates known as chaebols. When international lenders, spooked by the regional crisis, refused to roll over these short-term loans, liquidity simply vanished. The country was on the brink of default. In a moment of national humiliation, South Korea was forced to accept a record-breaking $58 billion bailout from the International Monetary Fund (IMF), which came with strict and painful conditions that would fundamentally reshape its corporate and financial landscape. Malaysia, meanwhile, chose a different path. It also experienced severe capital flight and a crashing stock market. However, its Prime Minister, Mahathir Mohamad, openly defied the IMF and its orthodox prescriptions. Instead of austerity, he imposed strict capital controls, pegging the Malaysian ringgit and making it illegal to trade the currency offshore. This was a highly controversial move, condemned by many international economists at the time. Yet, it ultimately stabilized the Malaysian economy and allowed it to recover more quickly than its neighbors, offering a powerful, if contentious, alternative to the IMF's one-size-fits-all approach. Other economies in the region, including the Philippines, Hong Kong, and Singapore, were not spared. They faced intense currency pressures, sharp stock market declines, and significant stress on their financial sectors. Even the economic giant of the region, Japan, felt the aftershocks. Its banking sector, already weak and burdened by bad loans from its own collapsed bubble in the early 1990s, was further destabilized by the crisis in its neighboring markets. Extending what would become known as its lost decade, the crisis laid bare several systemic flaws that were common across emerging Asia. The reliance on short-term foreign borrowing created a deadly refinancing risk, where economies were constantly at the mercy of foreign lenders. Weak and poorly enforced financial regulations had allowed banks and corporations to take on excessive and often hidden risks. This overdependence on foreign capital made their economies incredibly vulnerable to sudden reversals in investor sentiment, a phenomenon known as sudden stops. Furthermore, a pervasive lack of transparency meant that corporate and bank balance sheets were often misleading, hiding the true extent of debt and bad loans until it was far too late. All these factors combined to create speculative bubbles that inflated asset values far beyond any sustainable level. The crisis was a brutal lesson that rapid growth, without strong institutions and prudent regulation, can easily mask deep-seated structural issues that are waiting to erupt. The IMF's intervention in Thailand, Indonesia, and South Korea remains one of the most debated aspects of the crisis. The fund provided billions in emergency loans to stabilize these economies. But the assistance was tied to a stringent set of policy conditions known as conditionality. These conditions included fiscal austerity, cutting government spending, raising interest rates to stabilize currencies, and implementing sweeping structural reforms, such as closing insolvent banks and breaking up monopolies. Supporters argue that these tough measures were necessary to restore investor confidence and impose much-needed financial discipline. They contend that without the IMF's intervention, the collapse would have been far worse. However, Critics argue that the IMF's prescription was deeply flawed. They claim that raising interest rates and cutting government spending during a recessionary crisis was like pouring gasoline on a fire. These policies, they say, intensified the economic downturn by choking off domestic demand, worsening unemployment, and causing immense social hardship. This debate over the IMF's role highlights a fundamental tension in global finance: the trade-off between imposing financial stabilization and respecting a nation's economic sovereignty and social well-being. The long-term consequences of the 1997 crisis fundamentally reshaped Asia's economic architecture and its relationship with the world. Determined never to be vulnerable again, countries across the region began to accumulate massive foreign exchange reserves as a self-insurance policy against future currency attacks and capital flight. As neighboring economies were weakened, China, which had largely weathered the storm, saw its regional influence and economic power grow significantly. Most Asian countries abandoned rigid currency pegs in favor of more flexible exchange rate regimes, which could act as shock absorbers during future crises. Banking systems underwent major reforms, with new regulations and stronger supervision to prevent the kind of reckless lending that had led to the collapse. Regionally, the crisis spurred the creation of the Chiang Mai Initiative, a multilateral currency swap arrangement among Asian nations designed to provide a regional financial safety net and reduce their dependence on the IMF globally. The crisis fostered deep skepticism toward the kind of austerity-driven rescue programs that the IMF had championed, influencing how future crises, including the 2008 global meltdown, would be handled. These painful but powerful reforms ultimately strengthened Asia's resilience, enabling the region to weather subsequent global shocks with far greater stability. Today, the lessons from the Asian crisis remain profoundly relevant for emerging economies across Africa, Latin America, Eastern Europe, and South Asia. The key takeaways form a modern playbook for sustainable development. First, avoid excessive reliance on short-term foreign debt to prevent liquidity crises. Second, build strong, independent regulatory institutions to oversee the banking sector and minimize systemic risk. Third, champion transparency in corporate and government finance to build lasting investor confidence. Furthermore, emerging markets are advised to adopt flexible exchange rates to absorb external shocks and to build substantial foreign reserves to defend against capital flight. They must also manage capital inflows carefully to prevent their economies from overheating and forming speculative bubbles. Finally, they must always prepare for contagion, because in today's interconnected global markets, a crisis in one country can spread to another with astonishing speed. The 1997 Asian financial crisis was not just a regional economic collapse. It was a watershed moment in the history of global economic governance. It exposed the profound dangers of uncontrolled capital flows, weak regulation, and inflexible currency systems. It taught the world that the miracle of rapid growth is fragile if not built on a foundation of stability, transparency, and resilience. For today's emerging economies, the crisis serves as a powerful and enduring roadmap, offering critical lessons on how to balance the pursuit of growth with the prudent management of risk, ensuring that history does not repeat itself.